Natasha Phipps. I am the CEO of WealthShare Real Estate Investment Trust, and we like to provide value where we can. We like to share information, make information accessible, and we know that a lot of our investors are also actively investing and actively buying real estate. And so that kind of leads to tonight. We do all kinds of different topics, but tonight we are talking about the CMHC programs that we have offered. We have Deidre here joining us, and I will let her take it away here in a moment. But the point of this is to really give you guys an overview of the programs and some kind of introductory information. And hopefully you guys find that of value. We are recording this, like I said, so as we always do, we can send you the recording if you've missed some of it or need to jump off. But I'll let you take it away there, Deidre.
Okay, thanks, Natasha. So thank you for the invite to be able to come out and talk about CMHC. So Canada Mortgage and Housing Corporation does provide default insurance for multi-unit residential properties. We define multi-unit residential properties for properties that are 5 units plus. And so we could have 5 units or we could have a 400-unit complex. So we insure all across Canada. A little bit about my role. This is a bit of an exception. I generally don't meet with investors or borrowers. My role is primarily to deal with the financial institutions, as they are the lenders for these projects. And simply under our mortgage loan insurance for multi-unit, we provide default insurance for those projects. So I've been with CMHC for 17 years, and I've been in the multi-unit space for about 5 years. It's an ever rapidly changing space to be in. Learning every day. I learn something every day. So I'm happy to just be here today to just provide a high-level overview of what this program looks like. So I'm just going to move forward. And it's a short presentation. It won't take too long to go through. And if there's some questions at the end, you can, by all means, I'll be able to answer some questions. Nothing particular to underwriting because I'm not an underwriter. I more so work with lenders to help them prepare their files to be able to submit to CMHC. So why CMHC is in this space is because increasingly more and more Canadians do rely on rental housing as an alternative for home ownership. Higher interest rates, down payments, it's hard to come up with in markets like now where inflation's been high. It's hard for people to be able to save for a down payment. So there is a need for the creation of multi-unit rental units across Canada. And I know it's no secret, we're talking about the need for units based on our immigration and just other factors that come into play when it comes to determining what our requirements are for households. So in front of you, you'll see we do have a wide spectrum of housing for multi-unit. Today, I'm talking about the affordable and the market housing, but through the National Housing Strategy, there are other programs where CMHC is the funder or lender in those programs. Today's presentation is just on the commercial side of mortgage loan insurance, which is our affordable housing program, which is MLI Select. I'm sure if you are in the multi-unit residential space, many of you may have heard about MLI Select, and I will touch on that briefly, as well as the market housing. So we offer mortgage loan insurance, again, default insurance for both market and affordable, accessible, and or energy efficient housing. And the types of transactions that we see are new construction. And when we talk about new construction, we can look at construction financing, so insured financing throughout the project, or if a project is built conventional, then we see a lot of applications that come in at the takeout. So you build the property as conventional, and then at the end, when it's ready, leasing up, you'll come and get an insured takeout loan. We also do purchases as well as refinance. So we do also have various types of multi-unit shelter models. Primarily what we see, and I would say probably 80% of what we see is standard rental housing. So that is, you build a 10-unit purpose-built rental. We can consider mixed use where there is a small component of non-residential. Could be you have 40 units and the main floor might be commercial. So we have guidelines with respect to that, in that 30%, the commercial space cannot exceed 30% of the total floor space or loan amount. So primarily what we see is standard rental. However, we do see a lot of applications on student housing as well. Student housing, we have two options. We have on campus and off campus. Retirement housing is next. And again, we do not have an appetite for long-term care because long-term care is the purview of the provincial governments. When we talk about retirement housing, we're talking about independent living, so a 55 plus or a assisted living project. Now, we do in some provinces where they have where a provincial health agency would sign into a tripartite agreement, we may see a small component of long-term care. And what we mean by that is a lot of the projects are built with the idea that you age in place. So you start out at 55 plus, then you move into assisted living, and then you move into long-term care. But we would not look at insuring an entire project that would be long-term care. It would be a very small component of the overall project. We also have single room occupancy. So the buzzword that's going around right now with respect to single room occupancy is called co-living. So you may have a 3-room unit and they rent it by the room, and then they have shared amenities like a shared bathroom, showers, kitchen, and so forth. So that would be our single room occupancy. And then supportive housing is more where we look at transitional, in the sense that let's just say that someone has supportive housing for people that have traumatic brain injury. And generally when we see supportive housing, we generally will then see that there's non-residential space that have supports built within that project to help people move on. So they're generally just there for a short period of time. So again, we do have shelter models, have multi-unit shelter models, but most of what we see is our standard rented housing. We're starting to get a lot more applications for student housing and retirement housing as well. So when we look at an application, we're looking at the borrower, the property, and the market. I won't go too deep into the weeds here because, again, this is a conversation that we have with the lender. We don't actually have a presentation that we would present to the investors, because the lenders are the ones that are going to talk about all the loan and interest rates and what would be required for you to get a loan, a multi-unit loan for them. However, I will touch on this very lightly. So when we look at the borrower, they have to have property management experience for this type of property that they're applying for. So sometimes we'll see that, you might have an investor that has maybe 5 or 6 single family homes as a rental portfolio. And now they want to go into a multi-unit project that might have, let's just say 25 units just to start. We may not consider the property management experience of managing 6 individual homes to be equivalent to what would be required to manage a 25-unit building. So, and when we talk about property management experience, we generally look at least 5 years. Now, having said that, there are options. So if this is a route that you wanted to go into with a multi-unit project, we may give you the option that you could hire a third-party property manager that would meet our requirements for property management experience. The other thing that we look at with borrower is we do have a minimum net worth requirement of 25% of the loan amount. And when we look at a net worth, we're looking at realizable net worth, but it has to be 25%. Now, the equity going into the project would count towards that 25% as well. Next, we'll go. We're looking at the property, we're looking at quality and condition of that property. We're also looking at, we need an environmental site assessment. So a level 1 environmental site assessment, and that would determine whether there is any known contaminants. If there wasn't any known contaminants, we're able to move forward. If an ESA did identify that there was a possible contamination, a lender would then have to do an ESA 2 and then come up with a remediation plan in order for us to be able to insure that, that property. And then when we look at the market, we're looking at the location of that market, location of that property. We're looking at the rents for that particular property in comparison to rents in that market. And then we're looking at our vacancy. So when we look at the information for our market category, CMHC does an annual market rental survey. Basically, it's a bunch of retired CMHC people that all they do for 6 weeks is reach out to developers, property management companies, municipalities, and so forth to come up with what's happening in specific markets, what's the vacancy rate, what is the rents in those markets. And that information we do release in a report at the end of January, but it also is uploaded into our housing market information portal. So it's a really good resource if you're looking at starting to invest in rental in a specific market. You can find it on our cmhc.ca website, and you're able to drill down to actual neighborhoods so that you could go into Calgary, you can put the mouse over a certain neighborhood, and it'll give you a primary rental data. It's going to tell you what the average rents are for a 1, 2, or 3 bedroom. It'll tell you what the vacancy rates are for those type of units. And so it's a really, really good resource if you are looking at a specific market for multi-unit residential. And when our underwriters are looking at, when they're actually underwriting a live file, that is the first place that they will go to confirm or accept the recommendation from the lender as to rents and vacancy. It'll be to our own internal report. So when we establish lending value, when it comes to a project that's within 5 to 24 units, we will have to have a property appraisal report. And it's going to be a current property appraisal report. So the underwriters don't have to unless there's some concerns with the information that's contained within the appraisal, we can take the appraisal as a fair market value on that project. The appraiser is going to have comparables for the project. It's going to have comparables for cap rate and things of that nature and come up with their value. When it is a property that has 25 units or more, we look at the net operating income approach to valuation. So, I mean, if you have an appraisal and you want to send it in to be able to support, or you want to present that to the lender for them to be able to support the recommendation that they're going to come to CMHC with, that's great. The more information we get as underwriters, the better. But it isn't necessary for an appraisal to be submitted for CMHC insurance with a property that has 25 plus units. So when we're looking at establishing lending value on our market program, there is the maximum loan to value is 85%. And basically, when we are looking at a project that's 25 units or more, we're looking at the lending value being equal to the net operating income divided by cap rate. A lot of times the lenders will come to me and say, okay, can you kind of give me an idea of what we're looking at for cap rates in a certain market? We don't have access to that data. We don't prescribe interest rates. We don't prescribe cap rates. It's up to the lender, your lender, when they're submitting a deal to CMHC, to make those recommendations and be able to support the recommendations that they're making. And then we will use our own internal tools to do our analysis to see that we can support what the lender is presenting to us. And the other thing that's really, really important is the DCR, or the debt coverage ratio. So basically, the debt coverage ratio is how many dollars is required to service the operating expenses, and the principal and interest payment on the mortgage. So the debt coverage ratio is the calculation of net operating income divided by the principal and interest payment. On a market deal, I think actually that's the next slide. On a market deal, because I'm going to talk about Select or MLI Select in the next few slides, but on a market deal, rental properties with 5 or 6 units, if it's a purchase, the DCR is 1:1. If it's a refinance, it is 1.2. With properties that are 7 units or more, and again, keep in mind, this is market, on a purchase and a refinance, it's the same. If the term on the loan is 10 years or more, the debt coverage is 1.2. On terms less than 10 years, is 1.3. So when we look at that just in dollars and cents, that means that to qualify for CMHC on a refinance that's 10 years or more, you have to earn $1.20 for the debt that is being paid out. So that's kind of where that debt coverage ratio, and I'm sure you're all investors and so forth, so you probably will know that calculation as well. So here's the good stuff. MLI Select. Everybody likes MLI Select because CMHC has been very, very generous with respect to premiums and flexibilities. But in order for us to be flexible and give all the goodies, if you will, out, we want something in return. And what we want in return is affordability. So we want affordable units. We want climate compatibility, so energy efficiency on these projects. And we also want accessibility. So in order for you to give us these priorities, we're going to give you incentives in the way of debt coverage ratios, premiums, and so forth. So we're going to go just through that right away. So affordability. When we talk about affordability, and even just as from the federal government and so forth, affordability means that people are not paying more than 30% of their gross income for housing debt. So that is the real measure of affordability. So when we designed MLI Select, we designed it that for affordability, the units that are designated would be at or below 30% of the median renter income in the subject market. So I'm just going to use Winnipeg because that's where I am. And we're still basing it on 2019 data. I do believe that we are going to have updated data in the fall. But if I use Winnipeg for 2019 data, the median rental household income was $44,000. Now, 30% of 44,000 divided by 12 gives us a median rental amount of $1,100. So we're at $1,100. That's what we designate for the market of Winnipeg. So in order to get points for MLI Select, for new construction, 10% of those units would have to be at $1,100 or less. For an existing property, 40% of those units would have to be at $1,100 or less. And that commitment to affordability is for 10 years. Now, that doesn't mean that it has to stay at $1,100 for 10 years. What it means is those rents can now be increased annually, either by the rental tenancy board requirements, if that province has rental tenancy requirements, or by the CPI rental accommodation index. So it's not like we're saying you have to keep those rents for 10 years and you can't do anything about it, because we know and appreciate that operating expenses will go up and up and up. So we are giving the opportunity for those rents to increase by either one of those metrics. So when we talk about energy efficiency, we have criteria for new construction. So basically, we want to see a minimum of 20% of energy savings beyond the 2017 National Energy Code for Buildings, NECB, or the 2015 National Building Code. So NECB is for high-rise, so greater than 4 units. The NBC is for low-rise buildings. Now, if it's an existing property, then we want to see a minimum of 15% energy savings beyond the current baseline. So on an existing building, you'd have to get an energy consultant to come in, determine what the baseline is, and then they'd have to do modeling that would then show us that the improvements that you're going to make on that existing building is going to have an energy savings beyond that baseline performance. And a lot of this information is on our website. And what I will do after this is I will just send you, well, I'll send to Natasha so she can share it with you, is some links to some of the information that is on our website that you might find helpful.
That's great.
So with accessibility, we want to see a minimum of 15% of the units that are considered accessible in accordance with the CA standard. And I won't tell you because I'm going to send you the information anyway. Or if all the units in the building are built to a universal design. And or a building certification from the Rick Hansen Foundation Accessibility. Now, it's important to note that we want to see, in order to get points under accessibility, 15% of the units have to be accessible. However, the whole building has to be visitable. What we mean by that is if it's a 4-story building, it has to be 100% visitable. So there has to be an elevator if someone has a challenge to make that building accessible. So those are things to keep in mind. And again, all of this information is on our website. So when we look at MLI Select, and this is why most of the applications we've had in the last 2 years since this has been out, well, it's almost 2.5 years, has been MLI Select.
Yeah.
We have reduced premiums on that for both purchase and refinance. Loan to values up to 95% for purchase and refinance, and or for construction, 95% loan to cost, which the market is 85%. Depending on the amount of points that you're going to give us. Now you get points. The more you give us in those social outcomes, the more points you get. So if you give us enough points for 100, we're going to give you an amortization of 50 years. And contribution to replacement reserve fund, it's discretionary on a new build. We wouldn't require that there's a replacement reserve fund. However, on a existing asset, we may determine that there should be a certain percentage of EGI that is going to go into reserve fund for capital improvements and so forth. So basically, you have a lower equity contribution, which will give you a faster return on investment. So again, we'll just compare the MLI Select to standard. So you have a loan to cost or loan to value up to 95% versus 85% for our market. For construction financing, there is no required rental achievement holdback, whereas in a market product, it would be a holdback of 10%, and that would be held back until the EGI had been met. Lower debt coverage ratio, so it doesn't matter what the term is for MLI Select, it is 1-to-1 versus 1.3 for market rental. And reduced premiums, so 3.75 versus 6%. So those are what makes MLI Select very, very attractive to investors. So fees and premiums, just touch on that. So there are application fees for an underwriter to underwrite the file because they fully underwrite each application that comes in. So for new construction files, the application fee is $200 per unit or bed to the first 100 units or beds, and then it drops to $100 per unit or bed to a maximum of $55,000 per loan. With construction advances, the lender is required to get CMHC approval for the first advance and the last advance. They can do as many advances in between the first and the last without us having to provide approval. However, if a lender determines that they want us to provide an approval on each draw, it's $350 per advance after the first and the last, which is not, there's no additional fee for that. Now, as I said earlier, CMHC does consider mixed use buildings, but where the commercial space is very, very low. So the application fee for mixed use is 0.3% of the non-residential loan amount. Now, the other thing, if you're looking at a project that does have a mixed use, the DCR on the commercial space is at 1.4, and the loan to value or loan to cost for that commercial space is capped at 75%. Because CMHC is not a commercial lender or a commercial default. We are a residential, but we do appreciate that there are some projects that it makes sense to put a small commercial, especially if you're giving us a higher level of affordability. So at least having commercial in there would offset some of those rents that you may feel that you're losing out on because you've committed to this affordability.
Mhm.
On an existing project, it's $150 per unit or $100 per bed. Again, for the first 100, then it goes to $100 per unit or bed and maximum loan amount of $50,000. Again, and because this is an existing asset, there's no advances because it's existing. But the same requirement exists for the non-residential space. And this slide will just kind of give you an indication of what the premiums are. So if you're looking at 100 points for a existing asset, you're paying 2.55, where it's 5.35. Now, the other thing with standard rental housing that is the amortization is capped at 25 years. However, you do have the flexibility on a market deal to go to 40 or 50 years now because on new construction, but you end up having to pay 0.25 for every year, every 5 years past 25 years. There isn't that requirement with the MLI Select. You just give us lots of social outcomes and we're going to give you low premiums, extended amortization. Also with the MLI Select at 100 points, we can waive our requirement for guarantees on that loan, which is also can be very attractive. So as I said, I'm going to send out the links to Natasha. She can share it with everyone that's on the call. And a lot of the information, again, I'm just doing this as a high level, but it goes into there's a lot more information on our website that you can do a deeper dive on that.
Awesome.
And we do have our multi-goal line. So, I mean, generally we deal only with the lenders unless it's a very general question. But if you have a general question, you can send it to our FI multi mailbox. And again, I'll share that with Natasha as well. So that's all I had for a presentation. And I'm at 7:29, so I think I did pretty good.
We're like, right, perfect. 30 minutes. That was
But if
amazing.
there's any questions, I can take a question or two.
Yeah. I have one if someone's thinking of one. Of like, is there something commonly, I know on the like sales side, on the acquisition, there's common things. Is there like kind of like one thing you think of that's like the largest misconception maybe about CMHC or these programs that you're kind of find yourself continually clarifying?
Not well, again, because I deal with the lenders are the ones that I think timelines, you know, if like again,
Yeah.
we're very, very busy. So, you know, it could take 3 to 4 months, depending on the size of the project, to get an approval from CMHC. So I find that those are some of the challenges that developer or investors have is these timelines. We have made some recent changes, which has made the investment community very happy because when COVID hit, we had a restriction on use of funds for any refinance and that restriction was that it had to be invested in future in investments in multi-unit housing. So now we've lifted that. So a refinance can be used for, you know, it could be used to pay out shareholder loans, VTB, it could be used to, you know, do improvements in the property. So that was one of the big ones that we used to get a lot of questions on.
Yeah.
And now we're not seeing that. Another big change that's happening effective September 3rd is with, in the last few years, we were in the position that approved lender correspondents or commercial brokers would be able to submit deals directly to CMHC. Effective September 3rd, we'll only accept applications from approved lenders. So those are just a couple of things that have just changed in the last little while.
Yeah.
We will be putting out updated median rental income. That'll be coming out in the next few months.
Fantastic. Wow, well, we were very lucky to have you this evening. I don't see any specific questions, so I think you have done an excellent job of giving an overview here this evening. And for hop hop off. I believe you've been so gracious with your time. So I was going to go over kind of some of our experience with the program on the acquisition side. I think that'll be helpful for those here that might be interested in going down that path and can provide some context there. But I think that was an excellent overview of what the program is and what the options are. And we at WealthShare actually have used the market route and the MLI route. So we've taken advantage of both. And I think there's a lot to offer for both. Oh, Deanna asks, I think this will be listed on the website, but who the approved lenders are, I believe will be listed on the website when that time comes,
Yeah,
right?
so if you go to our CMHC.ca website, there's a search bar. If you just put NHA approved lenders, they're all there. Now, one of the things that it's being updated right now. So if you, for regional lenders, such as credit unions, we're in the process of setting them up as standalone approved lenders. But if you're looking for a credit union in a specific province, if you click on the central, like Credit Union Central of Manitoba or Alberta, there's a little arrow. Then underneath that arrow, it will give you all of the credit unions underneath that central. And the reason I point that out is because that's a couple of calls. It's like, well, my credit union isn't an approved lender, but it is. It's just approved under the central.
That's a really good tidbit, actually. Fantastic.
But everything else is there.
Yeah, no, there's so much information on the website. There is a ton there. So definitely lots to dive into. Rex, I can answer that after. You do need 5 units or more for the program, which we discussed.
The one thing I do want to point out, just going back to that question about approved lenders, if you go look at, you want to make sure that the approved lender is approved for the province that you're looking for, because some lenders have certain restrictions with respect to where they can operate. So that's, if I can just point out that other thing, especially with the regional lenders.
That's huge. Just one more question. Rex had asked, if you get the 100 points, the guarantors can be waived.
Yes.
Does that, right? That's kind of across the board.
No, the only thing is with guarantors, so it can be waived. Now, if it's new construction, because of course there's a lot of risk for new construction, there's guarantors have to be in place for 100%. And then once the asset is stabilized. So kind of just to give you, we have a definition. So an existing property is a property that is stabilized. So it's had 12 months of consecutive EGI or 24 months from first occupancy. So that's our definition of an existing asset. Anything outside of that would be considered new construction. So new construction, until the property is stabilized, reaches that 12 months of consecutive EGI, 100% of the guarantees are in place. But once it's stabilized, then we'll release those guarantees. Now, having said that, the underwriter always has the ability to mitigate risk. And if they determine that the risk of the file justifies that we have to have guarantees still remain in place, that's the determination of the underwriter, but we wouldn't know until an application is submitted. But MLI Select was created, 2 things, not to have a rental achievement holdback, and 2, if you achieve 100 points, not to have a requirement for a guarantee.
Awesome. That's a great little tidbit there. And we can dive into more of that as well. We have gone through some of that too. So good questions. Good question, Rex. It's a great point. And yeah, I think we can leave it there. I think that was an awesome overview. I really appreciate your time. For those resources, I will, of course, send those out to everyone that registered for this evening, but I really appreciate your time and thank you so much for joining us, especially when you're at your beautiful cottage.
Thank you. Well, yeah, everyone have a great long weekend. It's the last weekend of summer.
You too. I know. Thank you so much.
Okay, bye-bye.
Okay, bye-bye. So if everyone wants, I can kind of dive into a little bit of a few major topics that I think are important. Before that, I did want to ask, is there anyone here who has like already went down the program with either MLI or market route already? Or is this something most of us are kind of wanting to go down the path possibly? If you let me know that in chat, or you can unmute yourself, we can have a conversation as well. I think that would be great. There's so much information out there, and this program specifically has evolved so much from when it first was released. The MLI Select program So much so that it seems like even the brokers for quite a stretch there were having a hard time keeping themselves caught up. But I think just, briefly from my background is, of course, as a realtor first. And so I help clients acquire these assets. WealthShare, of course, we have acquired these assets and are using these programs. And so I have the experience from kind of the borrower as well as the salesperson trying to help people go down this path. And I think a few things to point out right away. It seems like everyone here is kind of interested, not, quite sure as well. There's a lot of information out there, but a few kind of key differences to point out right out of the gate is, which she did talk about at the very beginning, was from the borrower's perspective. First thing to understand is CMHC is going to provide the kind of default insurance, just like if you were going to buy your primary home, but they're doing it for multifamily real estate. And they are the only insurer, though. On your primary residence, there is multiple insurers out there. In Canada, for multifamily, it's only CMHC. So that's one, there's nowhere else to compare this to because they're it. And they will look at the borrower. So one thing I see a lot online and posts and Facebook groups is a lot of misleading information on these programs. So I want to clarify a few things. I think it's quite helpful. They definitely do look at the borrower. I can't tell you how many times I've had investors come to me and say, like, well, just go find me a good asset and then the asset's going to qualify. No, that's true and not true. So they will look at the borrower, but your net worth is what's more important. Whereas buying a primary residence or just a single family rental property, your income is really important, plus your credit. They definitely are still going to pull your credit. They definitely will look at your credit, but they want to see your net worth. And the loan amount that they're willing to give you, you must show 25% of net worth for that loan amount at minimum. So if you want a $10 million loan, you need to show at least $2.5 million of net worth that is, could be accessed in the event of XYZ happening. So that's the big thing right out the gate. They will definitely care about you. Net worth. The experience one is something that a lot of people get caught up with as well. You definitely need to, if you are not an experienced multifamily building operator, you have to hire property management. It's not even a choice. And they definitely will want to see your management agreement and check those things to make sure that these assets are being run by someone who has the experience. The MLI program and the variables, right before she kind of dove into that, she talked about evaluating the asset. And this is where I think, from a consumer standpoint, has the most variables that is very misleading, because people see the terms 95% loan to value or 85% loan to value or whatever type of debt they're looking at. And value does not mean purchase price. That's the biggest thing that is misleading. And people think, well, it's a $10 million property. I only need, 5% of that down. And that's very misleading. And so value is determined how the property operates. So your property's valuation will be done, as she said, with the income approach. So an appraiser is going to come, look at your income, look at your asset, all the expenses, management costs, everything like that. And it's going to determine a value combined with the income approach and whatever cap rate they're going to be using for that area at that time. That's what's going to determine the value to them, not what someone across the street sold their building for or whatever. It's solely based on those factors, which is what I love about commercial real estate, because you can build the value. The WealthShare assets that we have acquired, the first two were court-ordered sales. So they were all underperforming. None of them, even though they were new real estate, the rents weren't where they should be. The expenses weren't where they should be. And just by managing it right, we improved our value. We improved our appraisal value just by kind of righting the ship. And that's a huge, huge opportunity in the commercial space. But for a buyer or an investor, those are a lot of variables that are not promised or guaranteed. So that's a big thing. Rodney, did you want to say something? Were you just going to say something?
Yeah, I was just going to add to the end of that, because cap rate's one that if you hear the WealthShare team talk at all, we kind of sometimes have a little bit of a chuckle around cap rate, but I think it was really important what you spoke on, which is that the cap rate's determined by the lender, based on the evaluation of the area and all these factors. It's not a number just plucked out of thin air. So if you don't understand what goes into making a cap rate, it can be thrown around in casual conversation, but you have to be able to present the cap rate that you're deciding or you're presenting. You have to have the backing to represent it as being accurate with the lender's collaboration, right? So it's not just a number that you can reference and pull out of a market, because even within the markets they can vary and they can change, they can range, and even most importantly, from really one of my big takeaways was when she mentioned this cap rate that you work on has to be agreed on with the lender, not CMHC. It's not a CMHC thing, and I think that's something that hasn't always been communicated to us correctly. It's the lender's job, which really means it's your job as the purchaser to properly present that evaluation and the reason behind choosing the cap rate you do, because a cap rate can adjust.
Has a range. There's usually a range though based on the asset class and the city that's commonly used at this point. But a 4.25 cap rate and a 4.75 cap rate will come in with a very different evaluation.
Extremely different valuation. And so you know, and those are two numbers that you talk to two different people. One will be referencing 4.25, the next one will be referencing 4.75. So how do you determine which one is applicable to your project and what you're doing? Well, if you don't understand the full workings of what you're presenting to them, or even what a cap rate is, I mean, we see people use cap rate when it comes to residential and stuff, and it's a term that so. And I believe there was just a question about what is a good cap rate. I don't think you can answer that. There's so many determining factors on what is a good cap rate. It depends on your project, your market, so many things. So it's and I think it's hard to guide and just go and say this is a good cap rate, this is a bad cap rate, because there really is no such thing. It is the cap rate that exists for that market and for that deal.
Well, like speaking very generally, a asset that's in a class A asset will have a lower cap rate. If say you're buying a really rundown property in a not so great neighborhood, it's probably a C asset, D even, will likely have a higher cap rate. Those two strategies are very different than buying a turnkey building with a lower cap rate. So Crystal makes a good point. Like you will have this conversation with your appraiser. And then they're gonna make the argument as to why this cap rate was used. So I think even that was a good cap rate is like talked about on social media, these groups and things, when it's really, there is like a lot of flexibility around it, and really depending what type of strategy you are deploying. So it's not that simple. We could probably have an hour-long talk and do honestly calculations with cap rates, but your appraiser is really, really important in determining that. I wrote something else down I was going to mention about cap rates. Oh no, not cap rates, but the other variables. So I mentioned how your valuation of your asset is based off the net operating income. Okay, so that's one factor. But when you're doing your net operating income or you're doing your analysis on a property, you're going to put in a number for vacancy. You're going to put in a number for your interest rate that's going to be used. Those two are huge variables that are very different than what you will see in the residential space. So the vacancy rate, even though you may know that in this area of whatever area you're looking, there's pretty well 0% vacancy, that does not mean that CMHC is going to put in a 1 or 2% there. They're going to take probably a 5-year average for a lot of Alberta right now. So even though it's like 1.2 for a community, and it may even say that in the CMHC report when you look up Calgary, Central, what zone that you're looking at, that doesn't mean they're going to take that number. So I see in a lot of performas and analysis people plucking that number out of the report, and that's not realistic. And the reason that's so important is if your vacancy rate in your performa is 1% of what, and CMHC is going to use 3.5%, what do you think happens to your valuation if we have those two things being so drastically different? It's a massive, massive difference in what you think the value is and what you think, and then what CMHC will also use. And also, there is some flexibility here. We have had our brokers go back and challenge vacancy rates and try to make a case for things. But at the end of the day, whatever the underwriter does ultimately decide is what you get. So having a broker that's going to work with you on this, be realistic with your pro forma and numbers is critical. And really that's, what it comes down to is the team, like every other event we've ever done. And whether it's Phipps Group or WealthShare, we talk about the team and the people, because really you need them to do something like this. So vacancy rate is a big one. You can't just pluck out what is in there. So Southwest Edmonton, for example, in our last one, I think it was 1.2 or something in the CMHC report, triple that, because they took 5-year average, which is fair.
Yeah, 5%.
Okay, so even more than that, a little bit more than that. So that's a big one. So you can't just pluck it out of the CMHC report and use that number. Bond rates, that's the other one. So she didn't use the word bond rate, she had interest rates, but ultimately your lender is going to be charging you a rate that's going to determine what your mortgage payments are. And the bond market is constantly changing and evolving every single day. And so if you're looking at a property today and you're going to close in February, well, you don't know for certain what the bond rate is going to be on that day on closing. And that's really what determines what your actual rate is going to be, plus whatever you have worked out with your lender that might also go hand in hand with that bond rate. So that's another variable that when you're analyzing an asset, you need to have your best, middle, and worst case scenarios all thought through, because all kinds of factors could change between when the time you remove conditions to the time closing date comes. And that could really impact what your valuation comes in, what your payments come in at. And so these are big variables that are intimidating part of the commercial process. It's very different than in residential. You go sign your mortgage, you're done. You know exactly what everything is going to look like, and nothing will change from the time you remove conditions if you have everything signed to the time you close. And that's just not the same way here. So those variables changing. The rents on the MLI program, she did talk a lot about this, but I did mention that we at WealthShare have used the market, the standard CMHC insured MLI program. Everyone knows about MLI Select, and that's the kind of one that goes up to 95% loan to value. But it does come with, as she said, playing with those social outcomes. The more points that you give, the more kind of rewarded you will get. But you also need to think about a few things. If you commit 40% of your units, as an example, to be affordable units, and you're locking those in for 10 years, you are now restricting those units to only be the rent increase by whatever the consumer price index dictates. And you are also making that decision if you want to sell that building. So if I want to buy that building from you now in 5 years, I now have to take that on. And I do think that's going to be interesting to see how that shakes out from a market standpoint in 4, 5, 6 years, when all these deals were made in the last couple of years. What are the numbers going to actually look like? Because I mean, no one has a crystal ball in economics to say in 4 or 5 years exactly what expenses are going to be and exactly where average rents are going to be. So it is something you need to consider, especially if you're not having a long-term outlook or vision with your acquisition, because you're making a decision for someone else down the road that actually might hinder you from being able to exit the property as you might want to. So something to consider there.
I was just going to add kind of little tail on that, because I think one of the things that we found over the last while is this talking point around 5% down by own a building with 5% down, and it's possible, of course, and it's the best case scenario. It's the best case situation. Everything works just right. the building is able to hit all the points, it classifies, it still makes money, and it can hit all those kind of things. That's a best case scenario. That's not the everyday deal. In fact, it's very few and far between. So I think people are coming to this sometimes thinking, oh, great, I can just go buy a house with, or a building with 5% down. And those are very, very few and far between. And when they work, that's great, but that's not what you're going to do on the average basis. That's a very unique scenario. And like you're saying, and I think even fewer of those people are thinking about, well, what about in 5 years' time, or what about when I'm ready to exit?
Mhm.
They haven't even stopped to think about that yet. So not only do you have to find a building that fits it just right, it has to be something that in 5 years' time or 10 years' time, if you have to wait it out, is going to still have that same value.
Mhm.
And it's I understand the initiative. It's a great initiative, and it's an important one, but I think sometimes people get caught in the mix of like, oh great, I can go buy a building now with no money.
It's challenging. Yeah,
Not
it's
that easy.
new construction. It's definitely more possible if it's brand new, but that's kind of where I've seen those deals make sense. But if it's resale real estate, it's really, really challenging. The other thing is risk mitigation, risk kind of management. Those deals where, you know, you're going up to 95%, let's say you get 95% to purchase price. You're pretty, leveraged. So as you're growing a portfolio, you might want to have some not as leveraged as others, right? Just because you can doesn't mean we always should, is the other thing. And so that's something we talk a lot about here, about risk mitigation too. And that's something to consider. So the standard market insured route is awesome as well, to be able to go to 40 years amortization, to be able to use bond rates instead of Bank of Canada interest rates with how high that they are, and to be able to go to an 85% loan to value. That is a great middle ground to me, to also on certain acquisitions that might not make sense for the social outcomes that the MLI program might need. So I think there's a lot of kind of middle ground cases that are being overlooked, or acquisitions, purely because they're not checking every single box from the full program. So most people don't even know what that is, the market program or the market route. They only know MLI Select. The constraint is on the allocated or specific. Okay, Deanna, that's a good question. So, and Monique, correct me if I'm wrong, because I know this has been mostly you doing this, but when you allocate however many units, if it's 10 or 40% or however many it is, you do have to specify which units those are, but you can change them and kind of swap them out as time goes on. Is that correct, Monique?
Yes, you are quite correct. When you apply for CMHC MLI Select program, you need to specify upfront exactly which units you're going to be putting under the affordability index. You are not allowed to change any of those rates during that time for that first year. You can only increase those rates via a CMHC CPI rate. You cannot use Bank of Canada's rate. It's based on CMHC's CPI rate, which they specify on a special link on their website. But you do have an opportunity to swap out units. So you might have, for example, a very low rate unit. Let's say, for argument's sake, $1,500, and the market rate is $1,900, for example. The following year, you might have a unit that is just below the threshold of the CMHC affordability index. And you could actually assign that unit now under the affordability, and then bring the other unit out and put it at market rate. So it is a bit of a complex way. You do have to be very diligent, because I can honestly tell you that on a yearly basis, you do get audited by CMHC on this, where they do ask you for the rent roll. They do go through the rent roll. And if they find any anomalies, they will force you to pay the tenant back any overages that you actually claimed from the tenant. So not that it's happened to us, it hasn't, but I'm just giving a heads up that they do audit. Don't try and see if you can try and hide it underneath the carpet. It will come to the front.
Rex, no, MLI market does not require any affordability. So you get the benefit of longer amortization. You get the benefit of the bond rates. being lower, at least right now, than Bank of Canada rates. But you're not using any of the point system. You apply for both and then decide, oh,
Good one. Haven't tried it. It's just not cost effective to do it because every single time you put in an application, you have to pay the fee per unit. So if you want to spend $5,000 for 2 options, you can try. I've got to be honest with you, Daniel, we haven't tried it.
And I would suggest that if it looks like it's going to make the select, like the points program, then there wouldn't really be a reason to have the secondary application. Like it kind of either meets it or it doesn't. You know what I mean? Like,
maybe.
yeah, I mean, I suppose you could, but I think the best answer to that is working with your broker or your lender. They'll be the one to best determine if it's worth spending what fits best for the project that you're looking to do, right? So hopefully before you put your application in, you fully run the numbers and analyze whether it makes sense to go with the points route or not.
Kind of largest like lessons learned in these acquisitions is have more capital than you think you need. That's like, I cannot tell you, we've learned that lesson time and time again.
Always.
And that's where I do get worried about some of these folks with the, seeing, oh, I've got, a couple $100,000, now I'm going to buy a building. Well, do you have an extra couple $100,000? Because you might very well need it because of the variables that I talked about. And those variables do change on a day-to-day basis, particularly like bond rates. Or if you get caught between, like, because these timelines can take you months to go through these and months to close. So let's say you put an application in today. I don't think this is going to happen in today's economy, but say you put an application in today, CMHC is using a vacancy rate of whatever, 3%. Let's say by time you actually get to receiving your COI and everything like that, and then you're going to go shop for your lender, the vacancy rate for that area, well, this could happen actually, the vacancy rate goes up by 2%, let's say, and that can happen if there's lots of new construction in an area. We learned that the hard way on the Bergen. New construction, CMHC at least communicate to us, is considered vacant property, even though it's not even up for rent yet or completed. It's like inventory that's coming, so they count it as vacant in that community. So those variables, will change year to year as the CMHC reports come out, but so will your bond rates be changing every day. At a certain point prior to closing, you can lock in your bond rate. I believe most lenders probably have that option, but it is pricey. It is not cheap to lock it in. The more days you lock it in for, the more it's going to cost you. So you're likely not to lock it in 3 months in advance. You're maybe going to lock it in a couple weeks or days. I can't remember if there's a standard rate, but your lender would be able to provide you that. And so again, it's like have cash available. So you find you want to lock it in, you got to have that cash available. So truly having extra capital available for these changes is really what you need to have. And Deanna, yes, plan for worst case scenario, best case scenario, and everything in between. And the other big thing with CMHC too, and Deidre did mention at the very beginning, is how much this program has changed. And we love these programs, but also the changes can impact you. So if you are, applying with this in mind of one strategy, and it's going to look like this with this point structure, and you want this program, well, there's been rumors about things changing and how they're going to calculate the points, and will energy efficiency have the same weight now as next year? So in the course of your acquisition, things can change, and it's something to just be aware of. And most of these, changes are going to affect your numbers, like in one way or another. It could be good, it could be not, right? So have extra capital available. That's just the main thing. And long timeline. So the only other thing I want to mention is the process of this, because I also see this online a lot, people texting in groups and stuff. People also think as soon as you get your CMHC COI, like you're done, but no. So if you're working with a mortgage broker, they're going to put together your package for your acquisition. You're going to apply to CMHC, you're going to pay the fees, then you're going to wait. You're going to twiddle your thumbs for a while, like Crystal said, a few months for sure. And when CMHC gets back to you, you're going to get your underwriter assigned. This underwriter is your underwriter. That is it. This is your person. And that's who you get. And all of them kind of can look at things a little bit differently. So you get your underwriter. They then will start working with your broker through the point of underwriter assignment to actually issuing your certificate of insurance or your COI. Once the broker receives your certificate of insurance, which, you know, could take weeks, can even take longer if there's lots of back and forth. It depends on the deal. Could probably take months for larger deals, I'd imagine. Once your COI is issued, then your broker can go shop that to lenders. So that's just the first step, obtaining your certificate of insurance. People go, I'm waiting on CMHC to remove conditions. No, that's just your step one. You now need to go find a lender. And then the lender also has their input and they have to be comfortable. So Deidre did mention that tonight. Just because a CMHC has a policy, for example, of if it has 100 points, you don't need a guarantor. Well, that does not mean that the lender is comfortable with that either. So the lender will have their own inputs and their own ideas and what their policies are, and all of them will be a little bit different. So ideally, you have a couple options to choose from. Another thing that I hear time and time again, and we've experienced this too with files, is there is a difference of how many lenders will be interested in your file based on the size of the acquisition. If it is an under $5 million loan amount, the amount of lenders that are willing to look at those deals is shrinking and shrinking and shrinking. It is not, plentiful, let's say. The larger the deal, the more appetite there is out there in the space. And so the smaller the deal too, you likely will pay higher rates from the lender, possibly higher fees. So because there's just less in it for them. So you got to be aware of that too. So the number someone might use for rates or fees on a $10 million mortgage is not going to be the same as a $2 million mortgage. So just bear that in mind as well. So really good questions to ask your mortgage broker. And really, guys, I mean, we have been through 3 acquisitions. We're in our 3rd refinance. So we've been down this path now a lot of times as borrowers, as investors, as your WealthShare fund managers. And you need your team. You need to rely on people. There's a lot of moving parts. It is very stressful at times. There's a lot of surprises. And so making sure you have a team. And of course, at WealthShare, this is what people love about investing with us as well, as we take care of all of that. But we also want to share what we're learning along the way, and help if you are, going down this path as well. But I would suggest leaning on your team as much as possible, and just be ready to be flexible, because things will change and things will come that you weren't expecting, I can imagine, through the process. So that was kind of everything I had written down. If there's specific questions anyone has, I can answer those as well. Rex asks, does MLI market require you to put your own assets at risk if your down payment is above 15% or no? Does MLI, we've had to guarantee all of our debt, whether it's the MLI Select or the MLI market. We have guarantees on all of them, but on our MLI Select program, we did not get 100 points. So Monique, I don't know if you know the answer to that, but our experience has been, and also Deidre commented that the lender may require guarantors. So we have guaranteed all of our debt. And like even the term down payment, Rex, is a little bit misleading, because you're going to put X down based on your purchase contract, but the valuation that comes out through your appraisal might not be specifically like 10% or 15% of that, right? As for all the reasons that we kind of talked about earlier. How much capital do you suggest to have as a float in addition to down payment on a percentage basis? How much additional capital as a float, like in case things go wrong kind of thing, I'm assuming, Rex? I don't know, between best and worst case scenario, Monique, I don't know what you would say in terms of, capital requirements.
From a working capital point of view, we all, to start off, we always make sure we've got around about 6 months worth of operating costs. And the reason why we do that is, you're buying an asset and you've seen it and you've had it analyzed. Somebody's actually inspected it for you, but things still crop up. all of a sudden, one of the furnaces might not work or something. So it's always best to have around about 6 months worth of working capital in place. Now, just to answer Rex's question, if I read it correctly, put it this way: none of our personal assets are at stake. In other words, we don't have our assets as collateral for it. The only thing that they do request, especially it comes from CMHC as well as from the lenders, is you do need to stand as personal guarantor. And the first year is always the harsh one, because it all varies. Sometimes you'll stand as 60% on the value of the loan. In other cases, that you are standing 100% guarantor on those loans for the first year. And then they do have an option for the second year where it reduces down to 40%. So indirectly, yes, your assets will be at stake, because if it does go south, you do need to have the capital lying around to pay off the outstanding debts if you can't sell the units in time or whatever happens. God forbid that it does. But with regard to the percentage down payment percentage basis, it all depends on CMHC. If I interpret your question correctly, CMHC actually dictates exactly what your LTV is going to be, what the percentage is going to be, and based on what Natasha mentioned on the factors, because they do a calculation on the VAT rate, they do the calculation on the mortgage rate, and then they work out what the loan value is. So yeah. Just make sure if you put 200,000 down, put 200,000 to the side.
Yeah.
Also, on top of that, have run about 6 months worth of working capital available, just in case. And then you can slowly but surely, as you start operating into that asset, you can start normalizing it and put it back into the system that you have in place for your properties.
And we've been asked to show our working capital as well to make
Yeah.
sure that we have it available. They want to make sure that you have it, and we've had to prove that too.
Yeah.
Yeah.
Out of the 3 acquisitions, 2 of them.
So in that case, I was just looking at the chat on the side. So in that case, when you put your own assets, and you said it wasn't collateral, so let's assume like the building went south, and does the like the CMHC or whatever, do they just like begin to try seizing your assets, then your personal assets, to pay?
No, it's not CMHC that does it. It's actually the lender.
Okay, yeah, the lender.
Yeah, it's a lender. So
Okay, so then
so effectively what really happens, if you actually have to follow the process, if things really and truly go south, you've got an asset and the market value of that asset is more than what you really paid for. And all of a sudden things really and truly go south and it goes to foreclosure. So it goes as a court-ordered sale. Because the lender wants their money back. So we know we're buying time out of this type of thing. And then it goes through the courts. So let's say you have an $8 million loan and it gets foreclosed upon for $7 million. You're going to be personally liable for that $1 million between whatever the sale price was and the outstanding value of the loan. That is seriously the worst case scenario. That's why I said, God forbid that it ever happens.
okay.
Yeah, I mean, obviously we have not been down that path ourselves personally.
No, we haven't, and we won't be, because the way we've actually bought our assets, we've always ensured that the assets have been appraised at a higher value before we even acquire anything, just for that reason alone. Because if you're going to be buying it, say for example, at $5 million and it gets appraised very close to $5 million, then you really have to question, is this the right move?
We will send, Deidre said she was going to send some resources and things, but yeah, there's a lot on the website, but you also need to be working with your broker. Like if you are looking at an acquisition, your first call with your realtor is with your broker, and we should all be working hand in hand together, because the realtor cannot do the analysis or the underwriting the way the broker's team would. Some of them will even go a step further and speak to their appraiser even before we write the offer, so that we have an idea of where this asset is going to appraise at. And they will also give us all the different scenarios. They'll give like a chart of different scenarios between market route, MLI route. And now, again, all these numbers can change, but at least what we know today, that's the kind of information you should have before you're even writing an offer. So because how else can you decide if it makes sense out the gate? But yeah, it's these acquisitions, like I said, hard to go alone, rely on your team, have extra capital available. And if this is all too much, this is also why WealthShare exists. And so we want to do all that hard work for you. There is a lot of analysis and research and work that goes into every single refinance and acquisition. And if you do go down this, plan to commit a good few months of your life to daily everything between lawyers, accountants, brokers, and your team, contractors, property managers. It's pretty intense, and you have to put all this together in a pretty bow to make everybody happy to close properly on time. So if anyone has anything else they need us, they can reach out anytime. But I hope this was valuable and helpful, and I'm sure it got some wheels turning on things. But if there's anything else, I think we'll leave it there. Monique, did you have anything else? Any words of wisdom?
No, just want to add to Rex's comment. Whatever you do, we all, especially if you're applying through CMHC and you're paying those CMHC premiums, whatever you do, just don't even bother asking the lender, why do I have to stand as guarantor when I've got insurance in place for this? Because it just falls on deaf ears.
Yeah.
So yeah. So I mean, Crystal did make the comment, and then it's 100% correct. I mean, if it is insured for default, so if you do default, you're actually covered by CMHC insurance. But yeah, whatever you do, just don't ask the lender, why am I standing as guarantor when I've got this, when I'm paying this premium? Because it just falls on deaf ears.
Yeah, they still want it, and it'll be part of your closing package. You can also, one tidbit, say you're buying an asset that you don't have enough net worth for, you can add guarantors.
Yeah.
So, like rent a guarantor. So maybe you would ask a colleague or a partner, someone to stand as guarantor on your project. You'd have to work all of that out, but they don't have to be necessarily the person purchasing the property. So there's all kinds of ways these, deals get put together, because not everyone, has the net worth needed to maybe get the type of transactions done. So that should open some doors as well.
Good point.
Yeah. Okay. Thanks, Susan. Thanks, Tamara. Thanks, Crystal, for all the support in the chat. Love it. Deanna, good to see you. If anyone needs any help with anything, please reach out. And if guarantor, it can be done anyway, just like anything else, it's all negotiable, right? So some groups will pay a fee. Some groups will offer equity. It could be a paid, like a percent of the loan amount is going to be paid to that guarantor annually, or whatever it could be. There's all kinds of ways you can skin those types of deals. And so, but it is done, both ways. So it just depends. And then if you're kind of standing in as guarantor, as the guarantor requirements reduce over time, then you would be removed as guarantor from the deal. Hopefully that makes sense. I couldn't even tell you what the average percent is. I don't know. Would you, Monique? I don't know.
Yeah, it's around about 2%.
2%. There you go.
Wait, I have a question. So when do you begin to get removed? So when as a guarantor, is it when the rents are very stabilized and then they feel comfortable, and then
yeah.
So okay, so when you get removed, you can't get put back on, right? In case, let's assume that there's a market crash and the rents suddenly go very low, they can't put the guarantor back at risk.
No.
Correct?
The only time they can do that is at refinancing, because it's valid for 5 years.
Okay.
But you'll never be removed as a guarantor. Your percentage of the loan reduces as a guarantor. So in the first year, it will be 100%, for argument's sake. And once you've got your rent stabilized and you've met your gross income for the period that they stipulate, then in the second year, that could reduce it to 40%. Then in the third year, it gets reduced to 20%. But you'll never be removed as a guarantor.
Oh, okay. So if I'm understanding, in the first year, you're liable for 100%, and then later on, by the time the third year, everything is going smoothly. Then you're only on the
it
hook
just
for like
reduces.
20% of the loan's value.
Correct.
Okay, I see. And that's for select and market, right?
Yes, for any of the
Okay.
CMHC products.
Okay, I see. Thank you.
Mhm. Yeah, that makes sense. About I mean, guarantor, it's, yeah, that's, I mean, it's, now you're sort of talking about joint venturing, right? If you want equity and you're going to stand in the deal for the term of the deal, then that's like a JV, you're part of the financial partner coming to the table. But yeah, that's certainly used out there.
I just
Yeah.
not to be that person, but all those percentages we're putting forward are just as an example and not to be quoted as, an
Yeah,
exact
so
case.
common, like what, yeah, but
Yeah.
like
Yeah,
anything,
but they're
all
not.
these
Yeah.
deals are negotiable.
No, it's not absolute, but it's based on the average.
Mhm. Okay,
All up for negotiation.
totally. Yeah, absolutely. Well, I think we'll leave it there. We're an hour, 20 minutes. If anyone needs anything, please reach out. If you'd like to connect one-on-one, I would love to hear from you. WealthShare we're still actively raising. We have 2 acquisitions in our sites we would love to look at in the coming future. So if you have not invested with us or you want to see what we're up to, please reach out. I always love to connect one-on-one as well. So does the rest of the team. So I hope everyone enjoyed this. You got a lot out of it, and I hope everybody has a great long weekend.